You look like you're fresh from a workout.
Me?
Yeah.
Nope. Eating animal crackers.
Are those your kids' animal crackers?
Obviously. No, I'm just buying fucking animal crackers.
Hey, man, they're delicious. I wouldn't judge.
Got a penguin. What's up, Shawnee baby? We are back. We're back on the old streams. What do you think about that?
Oh, JC's out of practice. He missed his cue to launch into it.
I'm gonna start it. I thought you were starting.
How's it been? It's been like a month since we've done this. Come on, man. What have you been doing?
I see the trades going through on the email confirmations and stuff like that. I was like, all right, baby, let's go. I'm just watching from afar. Been a little hiatus, little time at the beach, little time sick. Little time traveling, meeting some smart people. Maybe that's why I got sick from that, but feeling good. You know, looking at charts, got new monthly candles tomorrow.
Oh boy, I know how excited you get.
I got to tell you, Sean, I wouldn't get so excited if it didn't really add so much value. I mean, you are literally at a zillion of our meetings when we're talking about all the stocks, and like, we're not making this stuff up. Like, this is really valuable.
I know. But still, the childlike, giddy excitement you have at the end of every month is something to behold.
Dude, it really adds a lot of value. I'm super stoked. I got a Barolo waiting for me. I think you got to, monthly candles, you got to go Italian wine,
Not the Vino Noir we were talking about earlier.
Yeah. I don't know what all that is that Sean's drinking over there in Colorado. We got to get together more. But listen, so getting a lot of questions about the market. JC, what are you doing? What's the move? When volatility is high, I like to, sell some premium, collect some income. Energy's been one of the strongest sectors for the last couple of years. Took a little bit of a hit over the last couple of weeks, which puts it like in this range. And we like those range-bound environments for trades like this, do we not, Shawnee?
Right. So as you alluded to, energy and oil have been the leaders for the calendar year, for going even further back to last year, but one of the only sectors in the green this year. And while that's well and good, we've had a bit of a sell-off over the last, let's call it 3-4 weeks. Whether it's the hot money exiting the trade and now the cooler heads are going to prevail, or if the trend is over, we don't know the answer to that yet, but it feels like the market needs some time to figure that out, which plays well into our hands when volatility spiked due to the recent sell-off, and we think that we might be in a range-bound action as the market figures itself out. So that lends itself well to an options strategy called a short strangle, where we sell out of the money premium, we sell calls above the market price and sell puts below the market price, giving ourselves a wide range, a lot of wiggle room to let those premiums kind of erode away, let the volatility cool off a little bit, and hopefully we can profit. That's the plan here. And
these are the bands, right? So you're selling the 65 puts, selling the 85 calls. So as long as price stays within that range, we're good to go. And a lot of investors, it's like, well, is it going up or is it going down, JC? It's like, well, first of all, I never know which one it is. And in this case, we're not betting on either. We just wanted to just do a whole lot of nothing, and that's okay. We collect that cha-cha. And then what I also like about this trade, Sean, is that we are putting the probabilities of success on our side. Can you explain how much so?
Well, if you want to get nerdy and statistical on it, we chose those strikes, the 65 and 85 strikes, because they were beyond one standard deviation away from current pricing. So what does that mean? When you're talking standard deviations, it basically means that 67% of the time, you can expect the price to stay within that range. Now, that's not a guarantee, of course, right? But that's better than 50-50 odds that we're going to do, that the instrument's going to stay within that range. And here's the thing, JC, we don't need this instrument, XLE, to stay within 65 to 85 all the way until August expiration for us to make a profit. Right. That standard deviation score is speaking about all the way until August expiration. We just needed to hang out in this area for 3 weeks, maybe 4 weeks, maybe even less. And we're looking to take profits when we could buy this spread back for half of what we collected. So we sold it today for $275. I'm leaving a resting order out to buy this back at 135, which is just a little bit less than half of what we collected. And look, if this thing goes sideways for a couple weeks and if premiums come in, which are likely to happen if the market goes sideways, we could be out of this in 2 weeks. I mean, am I expecting that? No, but it's happened before and it can happen again. But as long as it happens within the next month, we're good.
We always say that. It definitely happens all the time because we catch ourselves saying it's not always like this, right? It does happen, quite a bit, because those are the types of things that can happen using that strategy. So it's not necessarily the goal, but it does happen where we're taking the profits in 3-4 days. Like, you're talking 2 weeks. Like, that definitely happens. We've seen it in days. But again, not necessarily the goal, just part of the deal that we make when we do this dance. But I really just want to reiterate the part of the strategy where we're the house. That's the point of this, right? So if you've ever been to a casino, you know the odds are against you. The more you play, the higher the probability that you're going to lose, right? Blackjack or whatever these things. So the house wins. That's why they're giving you free booze and show tickets and, flying you in, right, for the big timers.
Sure.
This is that. We're the house. So the more of these sorts of trades that you implement, throughout the year in your portfolio really adds up, Shawnee. I mean, I see it, obviously, front row seat.
That's right. And just to finish thoughts on why we chose these strikes here, in addition to the statistical reason, the 65 level, at least on the downside, is a significant level. It's got some price memory. That level had been some support in the past. And then the 85 level, not necessarily an obvious point of upside resistance, but it feels comfortably away. And we've already had the big thrust in energy that if energy decides to run back up and make new all-time highs, which it very well could, I don't think it'll happen fast. That's just my opinion, of course. I think it'll grind up more, which would play well to our strategy, because slowly grinding markets tend to lose premium in the implied volatility, which will benefit our position. So that said, JC, let's talk risk management. Risk management is paramount in a trade like this because we have theoretically unlimited risk when we're holding naked options. So we're going to keep this really simple. Now, there's one school of thought out there that says if you got a naked strangle on, you play defense and you roll your positions, you roll them out and you buy yourself more time. And you can certainly do that. But for us, we're in this because our thesis is XLE is going to stay above 65 and below 85. And if it doesn't do either of those things, then we are wrong. Our thesis is wrong. We're not going to fight it. We're just going to close the trade down, take what would probably be a loss, although not necessarily. It might not be a loss. It kind of depends on the timing of when it happens. But if there is a loss, it should be totally manageable. We will close it on any closing price of XLE above 85 or below 65.
I love it, Shawnee. No, I really like this trade a lot. It's a nice, what I also really like about it, and we'll end it with this, is that I like the sort of portfolio management, portfolio diversification, because trades like this are just different than other stuff that I have on, which might be more directional. And a lot of investors can make the similar case, right? A lot of their investments are directional. This particular trade is betting on a lack of directional move. And I like that. And that's something that you've always harped upon, sort of like looking at your portfolio, seeing what types of strategies you have on and balancing those out. So they're not all moving up and down together. I really like that a lot, Shawnee.
Yeah, and that this position actually was very needed in the All-Star Options portfolio right now because we have a bunch of long trades on, we got a bunch of short trades on, but all of our delta neutral trades either got taken out at profit targets or stopped out in the last couple of weeks. So we didn't have any delta neutral on in this portfolio. So always good to have one or two of these on at all times. So glad to have it on.
All right, guys, I'm JC Parets, founder of allstarcharts.com. As always, Mr. Sean McLaughlin, Chief Options Strategist here at All Star Charts, and my personal friend. And we're going to have some nice bets this upcoming football season. Miami plays Buffalo twice. I think we're going to the one in December, Sean.
I do that. We have to.
December in Buffalo, and then we'll go to Toronto, and we'll throw a party in Toronto. What do you think about that?
I love the idea.
All right, done. All right, guys. Adios.
Yep.